Hey guys, and welcome to the very first video market update from Louisbourg. I'm Marcel LeBlanc. I'm a financial planner here at Louisbourg, and I'm joined with my colleague here, Rob Currie. So, Rob, pretty interesting time where we're living today.
Yeah, it's very telling the fact that we're in the same building, but we're recording this in different rooms.
Yeah, it's not the kind of stage setup that we imagined when we first talked about this, did it?
Yeah, not at all.
No.
It'll do.
So interesting times also in the investment markets. Seems like investor sentiment shifted quite dramatically last week following the Fed minutes and reports. So maybe let's start there.
Yeah, so even backing up a little bit, if you look at the week before that, you look at it right about June 5th, we saw a very strong jobs report. And I mean, this really kind of blew us out of the water. Most investors out of the water, just thinking about us. We were expecting unemployment to continue to kind of edge higher and higher. But as states started to gradually reopen, we did actually see unemployment fall from about 15% down to 13.3%, which was in contrast to the expectation that we continue to rise. So the market obviously received that well and was moving upward in that trajectory. And then last week we had the chairman of the Federal Reserve, Jay Powell, go on and talk after the Fed released its projections. And really what the projections showed and then what Powell's speech thereafter really entailed was a slow expected recovery. And this was a little more pessimistic than the market was anticipating. People were getting really excited about where we were possibly going with that jobs number, and then lots of other expectations of more states reopening. And so that was really kind of what shifted the sentiment was this longer expected recovery.
Yeah. I mean, people initially celebrated the Fed showing up and supporting, but when they kind of got through the weeds of, oh, the reason for so much support is because they're expecting this to drag on considerably longer than the market might have been expecting, I think that's when people kind of hit the brakes a little bit.
Yeah, and even just put that in perspective, I mean, we had the Q1 GDP in the U.S. was down 5%, right about that. And Q2, which is where you have more of the actual shutdown included, there's estimates all over the place, but anywhere from down 20 to down 50%. And for the year, you have the Fed actually expecting, well, I shouldn't say the Fed expecting, but the actual, if you look at all of their estimates, what you end up getting in the middle is something like down 6.5% for the year. And this contrasts to the positive 2% they were expecting.
So that's an economy that might be down in the dumps for a while, might.
Yeah, exactly. Yeah. And so they have a few different numbers that they include in their projections. And so they have unemployment that we were hovering around 3.5% prior to the coronavirus outbreak. Now, as I said, 13.3% now. And they're seeing that get improved for sure over the next few years, but still being higher than where we were before. So even in 2022, we're seeing expectations of something like 5.5% unemployment. Okay. And I mean, another thing that the actual expectation for where interest rates will be as well. I mean, we've seen the Fed already bring them to zero, and the expectation is that they're going to keep it there for the next 3 years. Yeah. So really a longer kind of protracted recovery expected from the Fed.
And those low rates keep, usually inflate asset prices, right? So that's another reason why, that kind of fuels the fire for the markets, and especially stock markets to kind of be floating higher. So it kind of sets the stage. So I guess moving on, where does that leave the investment markets? I guess let's touch a little bit on the bond market, and then we can move into the more the equity markets or stock markets.
Right. Well, even before we get there, I mean, one of the most important things to think about here that the market's really contemplating is what the recovery is going to look like. And we were just talking about that, but really there's really a couple of different ideas of what we could see. I mean, as the economy comes back, we could see something like a V shape, which is really what the market seems to be anticipating, which is probably a little more bullish than what the Fed was projecting. And what we would have there is really kind of a snap back. As soon as everything kind of reopens, we're going to have really the same amount of economic output we had prior to the coronavirus. Mm-hmm. And then you have the U-shape, which is a more kind of extended version of that. And then you have possibly even like a W, where we actually start to reopen, things rebound, but then we have to shut down again. And so then we can talk about the fear of a second wave. And we're starting to see that fear really materialize as we look at, for example, Beijing starting to have another increase in cases. They're canceling flights and really try to crack down to try to really get a handle on that. And then we're also seeing some of the states in the U.S. that started to relax their shutdown measures. like Florida, Arizona, Texas, they're starting to report the largest amount of cases they've ever reported. So we're seeing a lot of really worrisome data on the fear of a second wave being a real thing. Mm-hmm. And so I mean that's kind of the backdrop. The economic backdrop is really it's not incredibly supportive, and there's a lot of uncertainty. That's one of the biggest things that we can stress. There's a lot of uncertainty.
Yeah.
So then, moving into like what we're seeing in the market, if you look at year to date, which is kind of a good way to think about, how the performance has been, S&P 500, which is the kind of the larger U.S. index that's often used to kind of think about the stock market in the U.S., it's still down about 3% year to date. And that's not an awful number, especially when you think about what the economic backdrop is. And so, I mean, and if you look at bonds as well, as I said, the Federal Reserve brought interest rates down to zero. Bank of Canada did something similar, and really central banks around the world have brought interest rates a lot lower. So as you would expect in a portfolio, especially in a balanced portfolio, bonds are going to outperform in an environment like this. So you have the actual bond index in Canada up 6 or 7% year to date. So we're seeing some strong returns there. But yields are also going down. So yields in Canada are just over 0.5%, and yields in the U.S. in the 10-year range about just over 7%, kind of in that kind of range. So that's kind of the setup for where we are right now.
Right. Now, speaking of the S&P 500, it seems like there's different pockets of such an index or the overall market that has been performing a lot differently than other sectors, right? You got the tech stocks kind of blowing up, and NASDAQ reaching new highs, and versus you got others pockets of an economy or pocket of businesses that aren't doing so well. Maybe we can talk about a little bit how that kind of is coming together in the overall picture.
Yeah. So as I mentioned, S&P 500 is up, it's down. We're about 3% year to date, but that's broken up into lots of different moving parts, right? So if you were to think about kind of the more technology-oriented companies in the S&P 500, which has a high representation in the NASDAQ, for example, you're seeing a lot of strong performance there. And I mean, some of that is certainly expected. And when you think about what's going on now, just you and I using technology right now in a way that we maybe wouldn't have before. I mean, it's clear the idea of software eating the world. Those trends are accelerating today. So some of that outperformance is warranted for sure. And so you see, even if you just look at some of the largest names in the index, this would be true of both NASDAQ and the S&P 500, Amazon, Apple, and Microsoft. Those names are up 20 to 40% year to date. So very, very strong performance for these companies. And so that's kind of bifurcated with what we see, what's going on in markets like the energy market, energy companies who produce and extract natural resources. They're really in the dumps at the moment. I mean, you think about what happened with the OPEC Plus and the amount of oil production that was brought onto the system to really push prices down. It's been a tough environment for oil companies as well. Then you have financials, which is another, industry that's been really hit because these are companies that are lending out to people that might be losing their job. And there's really a lot of question marks around, what's going on with that loan book. So, energy companies are down, let's say 30%. You have financials that are down maybe 15%, 15 to 20, depending on where you look. So there's really a big bifurcation in performance between companies that are clearly benefiting from this environment and then companies that are clearly impacted, notwithstanding the cruise lines and the airlines, which are down even more. So
hotels,
yeah,
etc. Yeah. So, and again, when we shift from the U.S. to Canada, the makeup, the S&P 500 is a much more broadly diversified index or a market for than Canada. So Canada does heavily rely on the financials and the energy sector as the makeup of the TSX. So has that impacted dramatically the TSX performance relative to the S&P?
Yeah, I mean, when you think about it, and that's a great question. I mean, the U.S. was typically much more diversified. I mean, if you just think about the amount of companies within the index, S&P 500, as it sounds, has about 500 companies in it. But if you look at TSX Composite has 250, call it, maybe give or take 10, and that's a big difference. So what we've seen is a lot of our larger Canadian companies end up having a much bigger weight in the index, and some of the largest companies we have are financials, are banks. And so, we've got a 30% weight in the index in financials. So that's a big weight down. We also have close to 15% in energy. So that's pulling us down. So, and there's very little, there's not a lot of weight in the technology oriented space, but in that space, we have a name like Shopify, which is now the second biggest company in Canada, right behind Royal Bank, that is basically doubled year to date. So, and this is a company that powers e-commerce. So, it makes sense. There's a lot of reasoning behind it, but this is off of what was already quite an expensive base. So it's kind of an interesting dynamic that's happening where the companies that are benefiting are being given a lot of credit for that benefit, and the companies that aren't benefiting, that are in trouble, are really kind of being passed over. So there's definitely a lot to look at under the hood.
And last tidbit I'd like to touch on is the emergence of the Robinhood traders and the emergence of the millennial trader that's kind of coming in. And there's a lot of talk, or at least speculation, that they are actually impacting the markets in some way, right? So all these younger, more risk-seeking, they might be seeing trading as an alternative to gambling, might be more willing to try to catch a falling knife, etc. They're looking for bargain deals, Has that been kind of impacting or shaping the market at all? Or is it just kind of a passing phase that investors are kind of largely ignoring?
Yeah, I imagine it's impacting. I don't have any clear data, but there's definitely been some announcements about the amount of account openings that are happening at Robinhood and other brokerage firms that do similar things. And it's been a great business for them over the past little bit. And one of the great examples of that is what's going on with Hertz, which is a company that filed for bankruptcy, and yet somehow started to get bid up in the stock market, and is now issuing equity to see if they can kind of help themselves survive. And I didn't spend a lot of time reading through the prospectus, but I guess they're warning investors that it's very likely this equity is going to be worthless. But
it seems like they're issuing equities to kind of finance the restructuring.
Yeah. So, there's certainly some distortions here. Anytime, you have, when the Federal Reserve brings the interest rate to zero, basically that's injecting a ton of cash into the economy, and primarily into capital markets. And then they're also doing asset purchases and having very specific lending facilities. So all of this is pushing a lot of cash into the hands of institutions and investors. And so what do you turn around and do with that cash? But there's definitely lots of things you can look at. But as an individual as well, you have the amount of fiscal stimulus as well. I'm getting these stimulus checks from the federal government, and I'm out of a job, don't have much to do, wanted to open an account, spend some money. So there's just a lot more money in the economy kind of floating around than there is typically. That's creating some very interesting moves, very interesting moves in the market.
It'll be interesting to see how it all plays out.
Yeah, exactly.
All right, well, listen, Rob, thanks for having a chat, and we'll do this again soon, man.
Yeah, for sure. Looking forward to it.
Here, cheers.
Cheers.